Hey guys, it's your friend Nate. I know you are all busy, so I am taking the time to break down the most important parts of a few different books I highly recommend reading. Today we will be looking at 712 by Craig Israelsen. If you like this breakdown, please like and subscribe to help me know to continue creating this type of content. Part 1. The importance of diversification. Building a secure financial future requires careful planning and smart decisions. One of the most fundamental principles in investing is diversification. Simply put, diversification means not putting all your eggs in one basket. It's about spreading your investments across different asset classes to reduce risk. Imagine investing all your money in a single stock. If that company performs poorly, your entire investment suffers. However, if you spread your investments across different stocks, bonds, and other assets, the impact of one poor performer is minimized. This is the power of diversification. Diversification acts as a safety net for your portfolio. When one asset class is down, another might be up, balancing out the losses and keeping your investments on track. By diversifying your portfolio, you're essentially mitigating the risk of significant losses and increasing your chances of achieving long-term financial goals. Part 2, introducing 712. While the concept of diversification is widely understood, putting it into practice can be daunting. Many investors struggle with deciding where to invest, how much to allocate to each asset class, and when to rebalance their portfolios. That's where 712 comes in. 712 is a straightforward, rules-based investment strategy designed to simplify diversification and make it accessible to everyone. The strategy divides your investment portfolio into 7 distinct asset classes, each playing a crucial role in overall growth and stability. This approach ensures that your portfolio benefits from the unique strengths of each asset class while minimizing the risks associated with overexposure to any single investment. Whether you're a seasoned investor or just starting, 712 provides a clear roadmap for building a resilient and rewarding portfolio. Section 1, U.S. Stock, the portfolio's backbone. The first asset class in the 712 portfolio is U.S. stock. This category represents the engine of your portfolio, aiming for long-term growth. We recommend investing in a broad market index fund like the S&P 500 or a total U.S. stock market fund. These funds offer exposure to a wide range of large, medium, and small companies across various sectors of the U.S. economy. Investing in U.S. stock provides a strong foundation for your portfolio, and this captures the growth potential of the world's largest economy. Remember that investing in stocks always comes with some level of risk. The stock market can be volatile in the short term, but historically, it has trended upwards over the long term. By including U.S. stock as a core component of 712, we aim to harness this long-term growth potential. Section 2. The second asset class in 712 is international stock, which complements U.S. stock by tapping into the growth potential of companies outside the United States. Investing globally broadens your investment horizon and reduces reliance on a single economy. Similar to U.S. stock, we recommend a low-cost, broad market index fund that tracks a global index like the MSCI ACWI ex-US IMI index. This provides diversified exposure to both developed and emerging markets. International stock can experience periods of outperformance and underperformance relative to U.S. stock. By including both in your portfolio, you create a more balanced approach to capturing global growth opportunities. Remember that international markets can be influenced by different factors that the U.S. market may not be, such as currency fluctuations and political events. However, these risks are mitigated by the overall diversification of the 7/12 portfolio. The third asset class in the 7/12 portfolio is real estate investment trusts, or REITs. REITs provide exposure to the real estate sector without the hassle of directly owning and managing properties. They offer a unique combination of potential growth and income generation. REITs invest in various types of properties, including residential, commercial, industrial, and specialized properties like healthcare facilities and data centers. This diversity within the REIT sector itself contributes to the overall stability of your 7/12 portfolio. REITs generate income through rent payments from tenants, offering a steady stream of cash flow that can potentially grow over time. Furthermore, as property values appreciate, REIT shares can increase in value, providing capital appreciation potential. While REITs can be sensitive to interest rate fluctuations, their inclusion in the 7/12 portfolio is primarily for diversification and income generation. They act as a potential hedge against inflation and provide a different risk-return profile compared to stocks and bonds. The fourth asset class in the 7/12 portfolio is gold, a unique asset that has maintained its value for centuries. Gold is often considered a safe haven asset, meaning that investors tend to flock to it during times of economic uncertainty or market turmoil. Unlike stocks and bonds, gold is not directly tied to the performance of any particular company or government. Its value is influenced by factors such as supply and demand, geopolitical events, and inflation expectations. Including gold in the 7/12 portfolio provides a level of diversification and potential downside protection during market downturns. When stocks and bonds are struggling, gold can act as a buffer, potentially mitigating losses and preserving capital. It's important to note that gold does not generate any income or dividends. Its role in the portfolio is primarily to act as a hedge against inflation and provide stability during periods of market volatility. While its returns may not always be spectacular, gold's ability to hold its value during uncertain times makes it a valuable component of the 7/12 strategy. The fifth asset class in our 7/12 portfolio is U.S. bonds, a crucial component for balancing the growth-oriented assets like U.S. and international stocks. Bonds are essentially loans that you provide to governments or corporations, and in return, they pay you interest over a predetermined period. This regular income stream is one of the key benefits of investing in bonds. When you invest in U.S. bonds, you are lending money to the U.S. government, considered one of the safest borrowers globally. This makes U.S. bonds a relatively low-risk investment compared to stocks. While the potential for high returns might be less, the stability they bring to your portfolio is invaluable. Within U.S. bonds, we recommend diversifying across different maturities. This means investing in bonds with varying durations until they mature. This strategy helps mitigate the impact of interest rate fluctuations on your bond portfolio. Remember that bond prices and interest rates have an inverse relationship. When interest rates rise, bond prices usually fall, and vice versa. By diversifying maturities, you create a more resilient bond portfolio that can better withstand interest rate changes. The sixth asset class in 712 is international bonds, which broadens the diversification of your fixed income investments beyond U.S. borders. Just like international stocks provide exposure to global growth opportunities, international bonds offer exposure to a wider range of interest rate environments and economic conditions. Investing in international bonds involves lending money to governments and corporations outside the United States. This can provide a hedge against potential risks associated with solely relying on the U.S. economy and interest rate policies. Similar to U.S. bonds, we recommend diversifying across different maturities within international bonds. This helps to manage interest rate risk and create a more stable fixed income allocation within your portfolio. International bonds can be subject to currency fluctuations as the value of the bond's underlying currencies can fluctuate against the US dollar. However, these fluctuations can also potentially enhance returns, adding another layer of diversification to your portfolio. Commodities, adding stability and inflation protection. The final asset class in the 712 portfolio is commodities. Commodities are raw materials or primary agricultural products that can be bought and sold, such as oil, gold, wheat, and coffee. They play a fundamental role in the global economy, and their prices can fluctuate significantly based on supply and demand dynamics. Investing in commodities can provide a hedge against inflation, as commodity prices tend to rise when the cost of goods and services increases. This makes them a valuable addition to a diversified portfolio, especially during periods of rising inflation. Commodities can also offer diversification benefits, as their price movements are often uncorrelated with those of stocks and bonds. This means that when stocks and bonds are struggling, commodities may perform well, potentially offsetting losses and reducing overall portfolio volatility. However, it's important to note that commodities can be volatile investments, and their prices can be influenced by various factors, including geopolitical events, weather patterns, and global economic growth. Therefore, it's essential to allocate to commodities strategically and within the context of a well-diversified portfolio. Part 3, 712 in action, the power of synergy. With all 7 asset classes in place, the 712 portfolio becomes a well-diversified investment strategy designed to navigate various market conditions. Each asset class plays a specific role, contributing to the portfolio's overall growth, income generation, and risk management. U.S. stock and international stock form the growth engine of the portfolio, aiming to capture the long-term growth potential of companies worldwide. Real estate, through REITs, provides a blend of growth and income, while gold acts as a safe haven asset, potentially mitigating losses during market downturns. U.S. bonds and international bonds offer stability and income generation, balancing the riskier growth-oriented assets. Commodities provide inflation protection and further diversification, reducing the portfolio's correlation to traditional asset classes. The true power of 712 lies in the synergy between these 7 asset classes. By strategically combining them, the portfolio aims to achieve long-term growth while managing risk effectively. This balanced approach is designed to weather market storms and provide investors with peace of mind, knowing that their investments are working towards their financial goals. Part 4, Embracing 712 for financial success. The 712 portfolio construction strategy, as we've explored throughout this discussion, is more than just a collection of different asset classes. It is a holistic approach to investing that emphasizes balance, diversification, and long-term growth. By dividing your investments across these 7 key areas, you create a resilient portfolio designed to weather market fluctuations and deliver consistent returns over time. This approach is particularly beneficial for those new to investing or overwhelmed by the complexities of the financial markets. 712 simplifies the investment process, providing a clear roadmap for building a well-diversified portfolio without requiring extensive market knowledge or constant monitoring. The beauty of 712 lies in its simplicity and effectiveness. It's not about trying to time the market or pick individual winners. Instead, it's about harnessing the power of diversification and letting the market work for you over the long haul. By staying disciplined and sticking to the 712 allocation strategy, you can potentially achieve your financial goals with greater confidence. Part 5, taking the first step towards 712. Implementing the 712 strategy is easier than you might think. The first step is to determine your current asset allocation. That is, how your money is currently invested. Once you have a clear picture of your existing portfolio, you can start making adjustments to align it with the 712 recommendations. This might involve selling some existing holdings and investing in new asset classes. For each of the 7 asset classes within 712, numerous low-cost index funds and ETFs are available, making it simple and cost-effective to build a diversified portfolio. Remember, investing is a marathon, not a sprint. It's about making consistent contributions over time and letting the power of compounding work its magic. Don't get discouraged by short-term market fluctuations or feel the need to make constant adjustments to your portfolio. Trust in the 712 strategy, stay the course, and you'll be well on your way to achieving your long-term financial aspirations.